I don't own gold because I'm hoping for a move from $1,925 to $2,015. I own gold because I'm afraid of a move from $1,925 to $6,000.
Yeah.
The consequence of that is that a $10 or $15 move, or the violation of some technical support, or the acquisition of some technical support, doesn't matter to me a whit. I'm completely disinterested in it. I own gold because I personally am afraid about the maintenance of purchasing power in my own savings relative to fiat-denominated investment products.
As the founder and CEO of Rule Investment Media, Rick Rule has carved out a distinguished career in the finance industry. In this video, Rick Rule sees gold as an essential asset, acting as a safeguard against the erosion of purchasing power. The precious metals market is expected to grow by $84.89 billion from 2022 to 2027. Over the last 20 years, annual inflation has averaged 3% in the UK, according to the Office for National Statistics. Over the same period, the price of gold has increased by an average of 9% per year, according to the World Gold Council. Whereas the average base rate, a proxy for the interest rate on savings, was 3% over this period, according to the Bank of England. Rick Rule advises to add silver to the portfolio during the latter stages of a gold bull market, having potential for outperform gold. Silver Gold Institute recently tweeted, "Price moves in silver are more explosive due to the size of its market compared to gold." 90% of the upward moves in silver happen in the last 10% of the precious metals bull market when retail investors jump in. Furthermore, Rick Skips focuses on tracking quantitative easing, debt, and interest rates to protect his savings from currency devaluation. A long period of higher interest rates would make the government's large debt pile costly, a possibility that is fueling a conversation about debt sustainability. America's gross national debt stands just above $33 trillion, more than the total annual output of the American economy. The debt is projected to keep growing both in dollar figures and as a share of the economy. Now, we are presenting the clips of Rick Rule insights from his recent interview with Sprott Money. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
I believe that gold and silver will become much more popular investment classes. I own gold because I personally am afraid about the maintenance of purchasing power in my own savings relative to fiat-denominated investment products. That isn't to say that I have all of my net worth in gold. I don't. I own gold as an insurance product. I remember well the decade of the 70s, and I'm too old to earn it back. That's why I own gold. I own some silver, too, because in the latter stages of a gold bull market, silver seems to outperform gold. So I own that as a more speculative asset class. But the truth is that Fed watching is not really an endeavor that I pay attention to. I don't pay attention either to what they say. My belief is that the political class, you can tell when the political class is lying when their lips are moving. I look at is the rate at which they are creating credit and money, which is to say quantitative easing. I look at the level of debt and deficits, and I look at whether I am being compensated as a saver by the interest rate they pay me relative to the deterioration of the purchasing power of the currency. We're going to take people through the basics of both royalty and streaming. Royalties being an interest in a mineral deposit that pays you a piece of the gross proceeds of the deposit without you getting a bill for capital expenditures or operating expenditures.
Right.
A stream is a prepaid right to receive a certain amount of product, often gold or silver, at a fixed price over the life of the contract. They're different instruments, but they're both financial instruments. They're both very, very, very high margin, lower risk instruments. It's ironic that because they're the finest instruments in the mining business, in a rip-snorting bull market, they perform less well than the gamier speculations. But certainly over the course of a decade, owning a better business is a better business proposition. And these companies, the royalty and streaming companies, have the most durable, the most stable, and the lowest risk revenue streams of any entrant in the market, which means if you are a long-term investor in natural resources, a case can be made that your entire portfolio can be constructed from royalty and streaming businesses in precious metals, in base metals and industrial materials, and in oil and gas. You can, in fact, construct an entire natural resource portfolio from royalty and streaming companies and de-risk to a substantial amount your participation, at least in the beta part of what I see as upcoming bull markets in both precious metals and industrial materials.
Rick expresses concerns about the potential delayed impact of higher interest rates and tighter credit markets. Gold prices languished near a 7-month low on Tuesday, weighed down by a robust dollar and elevated bond yields as the likelihood of U.S. interest rates staying higher for longer dominated sentiment. Meanwhile, Rick Rule finds the U.S. economy surprisingly strong despite rising interest rates, giving credit to the innovative nature of the American people rather than the federal. The U.S. economy has been able to avoid a recession this year, and a majority of experts still believe that the economy will achieve a soft landing, but some of the experts warn this expectation could be misleading. Let's get back to the interview.
I see the U.S. economy as being really remarkably strong compared to where I thought it would be after this many interest rate rises. I don't think credit for that is due to the Fed. I think it's due to the American people. I think the American people, by and large, are industrious, kind, and hardworking. I don't think it was the Fed that assembled a group of young people around a garage in Sunnyvale, California, that created Apple or created Google or created all those other wonderful engines of the U.S. economy. But I'm impressed by the relative strength of the U.S. economy. It's doing much better than I thought it would. My fear, of course, is that the impact of higher interest rates and the impact of tighter credit markets is a lagging effect, and that we'll feel it later rather than sooner. But that's an editorial. You asked me about the strength of the economy. And I need to say that the economy is in much better shape than I had anticipated it being in as a consequence of the increase in interest rates. I note, as an example, that new home sales and even sales of existing homes in some markets has slowed down as affordability around the 30-year fixed mortgage has decreased. The sellers apparently believe their house is worth what it was worth when the interest rates were less high. The buyers don't seem to be able to afford at higher interest rates those prices. So what you're seeing, rather than a move in price, is a move in volume down. Those moves in volume down in markets, in my own experience, do result in a change in pricing, usually lower. We'll see if that occurs. I think a bigger problem, Craig, that we need to be concerned about, both as investors but also as consumers, is the increasing unavailability and unaffordability of credit to below investment grade borrowers. Private businesses in the country, real estate developers, even public companies that have to access the junk bond market. If we see a real disintermediation in credit, a risk-off in credit, then I think perhaps you see the type of outcome that we've all been afraid of. I'm not saying it's going to occur, but when I look at things that keep me awake at night, the increasing illiquidity in credit markets below investment grade probably is at the top of the list.
The data suggests a compelling case for the continued significance of gold as a hedge against inflation and eroding purchasing power, especially when contrasted with relatively modest interest rates on savings. German-based firm Horaeus forecast for 2023 predicted that market tightness will ease later in the year, stating that silver demand is likely to increase following an uptick in polysilicon production, a key component of photovoltaic cells used for harvesting solar energy, which could support the metal's price. What are your thoughts on the future of gold as an investment? Share your thoughts in the comment section below. If you find this video informative, don't forget to show your support towards our channel by giving this video a thumbs up and subscribe to our channel, and turn on notifications to stay informed about our latest videos covering more exciting topics. Thank you for watching.